The S&P 500 is literally holding on by a thread. We have a market that needs the semiconductors to continue to rip higher in order for this thing to hold together. What is it that you have to look out for, and what are the risks? Let's dive into this. So here's what I think is actually happening. We continue to see the underpinning market deteriorating. We see breadth deteriorating. We see a bunch of Mag 7s that are stopping participation on the upside and relying on fewer and fewer stocks, particularly semiconductors, and a lot of these overseas markets like the Kospi and the Nikkei to keep all this momentum going. The thing is, they can only keep that momentum going for so long. And when that inevitably stalls, that's when the market is most vulnerable for the correction. Let's take a look at these charts. Here's the chart of the S&P 500. Now, last week, we had the pig and the python. We had 5 of the Mag 7 earnings come out in the same window as 4 major central banks. It was simply the moment where the market was going to be on pivot. We were saying that in order for this party to continue, these Mag 7s have to show that they've beat those expectations and still have room to run. Instead, the S&P 500 more or less settled in sideways. And when we take even a look here at the Mag 7s ETF, you can observe that generally the price action has been pretty sloppy. So let's quickly go through the Mag 7s and see where we stand, at least on the ones that had their earnings. Let's start with Apple. Now, Apple had what I call an exhaustion gap. It came out, beat expectations, gapped higher, and the sellers sold into the strength. We're now opening this morning at a lower level than we were going into the earnings. And that doesn't make Apple's chart bearish. What it does, though, illustrate was that the earnings were not this big momentum push that was going to have Apple continue to be leadership on the upside. We then take Amazon, and this is where we probably have the one Mag 7 that is actually genuinely bullish. Why? Well, it broke to 52-week highs with that earnings gap. It blew through all of the high volume node resistance levels with this gap. Now, the gap is filling a little bit, but structurally, this chart is probably the most bullish of all of the ones that we're going to be looking at. This, if so long as it can consolidate at 52-week highs, then there's room for continuation patterns on here. But then let's take a look at the Meta and Microsoft. Now, what we had here was Meta gap down on the downside. It was a vicious breakdown because it's the opposite of what we saw with Amazon, which is basically had a sustained trade range. You could try to put a head and shoulders kind of pattern on top of what consolidation was, and a distinct gap down that broke and now is consolidating the stock lower. Now, this is a stock that has lost all momentum and pivoted. Now, then we take Microsoft, which went for a double top retest pre-earnings and suddenly is faded all the way back. Not only did it give back any initial gain, but it's actually right back into this trade range. We're testing the 50-day moving average. Any legitimate breakdown from here is a stall out of the price action and a potential topping formation. Now, the other somewhat bullish one was Google. Now, Google did gap higher and is holding the gains better than Apple is at this moment. Now, the way I kind of look at Google is this. It's primarily a bull chart. It's still in its primary bull trend, but it does also have characteristics of exhaustion. Now, why is this important? Because when we take a look at these Mag 7s and ask, how much can they contribute to further taking the S&P higher, it is starting to put some doubt into that. Why is this important? Well, remember, on a market cap basis, these 7 stocks make up 36% of the S&P 500, right? The other 493 stocks make up the rest. And so at this moment, we have the scenario where these Mag 7s really needed to do the work. Now, what makes this more troubling is that when we look at the breadth of the market continues to deteriorate. We're at 40% of stocks above their 50-day moving average when we look at the 500 stocks within the S&P. That means 60% of stocks are in a downtrend and selling. That breadth has been deteriorating for months over and over again as we have been relying more and more on a concentrated small handful of stocks to keep this momentum going. That's why these Mag 7 earnings were so critical. Now, look at the way the breadth was deteriorating both before the Christmas drop and the Liberation Day drop. You saw the breadth deteriorating, and inevitably it led to a sell-off where we saw things break down to where even like 5% of stocks were actually trending. So this breadth continues to deteriorate. What other evidence do we have? Well, this chart right here shows that the median excess return of the S&P 500 on the day after earnings reports for companies that beat. So we're only looking at companies that beat their earnings. How much gains did they make? And what you can observe at this earnings season, this has been one of the worst reactions to bullish impulses on the upside. Again, demonstrating exhaustion, which is expectations were high and these stocks simply did not beat enough to meet these expectations enough for people to keep putting new money to work in them. And that's key. The other thing to observe here is that all of the money has continuously been flowing into the call options of these mega cap stocks. Everyone's been buying up all of this upside potential on these stocks. And so when people are using gamma to be able to buy market exposures on the upside, if the market does not deliver, then the dealer buying is not actually contributing to that further gain. We basically have a situation where these Mag 7 earnings were critical. So what has been working? Well, one thing that has been working and continues to work is the semiconductors, the SMH, and this is now what is coming down. When you have these other Mag 7s not being able to actually make the next incremental gain, we have these handful of stocks, particularly led by the number one stock, NVIDIA, right? Which is, you can see this chart, by the way, on the semiconductors, very bullish, broke out of a flagging formation. It technically measures out to 380 to 400. This sector has to keep ripping. This is why we're saying the S&P 500 is hanging on a thread, because as soon as these semiconductors stall out, there's nothing left to hold the S&P up. And this is why watching when this happens. Now, what's really powerful here is the fact that NVIDIA's earnings are now just several weeks away. So we have a scenario where this could potentially be setting up where the market maintains this for several weeks and even continues to build as the anticipation inside these semiconductors continues to go. And then we could have a scenario where NVIDIA simply can't meet some of these ridiculously huge expectations being built. And then if that in any way reverses the semiconductor trade, that could be the pivot. So what can we build upon that thesis? Well, first of all, let's take a look at NVIDIA's chart. And what I want to highlight here is that this chart is structurally quite bullish. You had a very clear bull trend. The entire consolidation basically held the 50-day moving average during the entire pullbacks. So very well defended. Breaks to 52-week highs. These measured moves are all the way to 230 to 250. That means that on the short term, there is not only has NVIDIA unwound its overbought state, but actually has room to run. And so this is why we don't want to say that the music is already stopped, but it is now relying on just a small handful of stocks to keep the party going. So will NVIDIA be able to finish off this move? What's also very interesting is not only has it just been like AMD, Intel, all of these other ones all kind of driving this, but they're in the international space, a lot of these Asian markets that have exposures to semiconductors have been ripping. We'll take a look at Nikkei, is going parabolic on the upside, and look at the way that the South Korean Kospi has now gone full on parabolic. Now, what's interesting here is that you can build a case here that as soon as we see a blow off in the Kospi, and as soon as we see that short-term blow off in the Nikkei, if that lines up with the semiconductors reaching some of these short-term peaks, and we don't have the breadth widen, and we don't have any other part of the market participating, then that could be a major market turning point. Have we seen it yet? No. But what is interesting here is the next few weeks are likely to see all of this play out. And this is the one thing that we're watching. How far can they take this? Where does it peter out? Where are the short-term highs? I'm watching this with my members day by day. How does this all end? And where is that key turning point where that risk really pivot? So what does this mean for your portfolio? Well, let's just put it into context. First of all, the biggest risk in the S&P 500, which is what normally impacts the most amount of traders, is going to be when do systematic traders potentially get triggered for another round of selling. Systematic traders have hundreds of billions of dollars to sell systematically without discretion when triggers happen. So what is it that what are the levels that you need to know? Well, look, the S&P 500 has a key trigger point along its previous low around 6,600. At the same time, the Fibonacci zone of this last leg higher lines up very closely with the rising 50-day moving average. Typically, a lot of these trigger points can align with 50-day moving average crossovers. What you see here is that the S&P 500 still has lots of wiggle room. It could take a 200 S&P point hit and still not trigger the systematic trading. So there's a little bit of wiggle room, which basically means that you don't have to be overly concerned like today is the crazy day where everything's going to unravel. But if we go through a week or two where the market is very heavy, fails to make higher highs, and all of this consolidates together, all of these levels will rise, maybe to 67, 6,800 on the upside. And if the market isn't progressing, then we're going to be crawling closer and closer to the edge of a cliff. And this is where we're going to see where this turning point on the S&P 500 is. So what do you do? Well, look, you don't need to go and sell everything. We don't necessarily know that when this turns, that it has to result in a devastating crash. But what we do know is that typically there is lots of downside volatility that happens when systematic traders get triggered, creates like this air pocket of selling that accelerates things, and gamma flips by dealers cause them to sell into weakness. All sorts of volatility has the risk of ensuing. So are we going to see this kind of a flip? And what should you do about it? Well, one of my favorite things to do is to hedge up a portfolio. Right now, volatility remains low. Like the VIX is down at the 17 level, which is still relatively low to where it typically is. Buying option premium is reasonable at this stage. But even then, buying some tail risk put hedges to just give some insurance policies to catch a quick 5 or 10% decline allows you to buffer some of that downside volatility while staying invested. This is while there's a lot of people being optimistic about big year-end rallies, I'm not. There's a lot of risks here, and it's important to be hedged up on your portfolios. So that's what you need to watch. If any of you want to follow me along on this stuff, the link is in the description below. Otherwise, I'll keep all of you up to date here in the days and weeks to come and see how this plays out.